Today we'll start with bond immunization. Okay, this is a very easy topic. It is very much logic based. Okay, so what is bond immunization? Bond immunization is, um, let's suppose you want to uh, study for MBA in the next 2 years. Okay, MBA in IIM. Okay, so how much money you need? You need roughly 29 lakhs. Okay, you need 20 lakhs for entering into the college and getting the course. Okay, for that, what you are thinking is how much money will you need to invest now. Okay, you need 29 lakhs after 2 years. Okay, so how much money do you need now that you need to save so that you will get 29 lakhs in 2 years. Okay, you need to meet a liability, so how much money you need to put now. Okay, so what you will do, you will do PV of 29 lakhs. Okay, now what happens is that you don't want to invest in shares. Okay, shares are very risky, so now you are considering the option of going to fixed income securities. Fixed income securities, you are seeking that let's invest in fixed deposit, but fixed deposit is good, but it's not that lucrative. Okay, not that much interest is getting, but slightly better interest you are getting in bonds, so you decide to invest in bonds. Okay, so you open the market, you see bonds. Okay, but you see that one bond, there is it is just for 1 year. Okay, and you are getting 7% interest or 8% interest, and the other bond, it is of 4 years and you are getting 8% or 9% of interest. Now you are confused whether to invest in 1 year 8-year bond or 4 years 9% bond. Which one will be good for you, for your to meet your liability. Okay, so that's what we are going to see in this chapter, that how we are going to do. Okay, so we'll assign weights to it. Okay, that after 1 year, let's say 8% you invest. Okay, 1 year after you reinvest again in it, so that you will get after 2 years you will get the amount. Okay, so how much percent you want to invest in both of them, 50%, 50% or 40, 30, what should be the ratio? That we need to find. How we will find, we'll see. Okay, so what we do here is we invest in at least 2 bonds. Okay, so I showed you that you saw 2 options which one to invest. Okay, 2 lucrative options. Okay, by proportionately, so that their weighted duration, that is the duration of bond portfolio, this is our Macaulay's duration. Okay, becomes equals to the duration of liability as follows. How? Duration of bond portfolio equal to duration of liability. Duration of liability will be given in question always. Okay, duration of bond portfolio is your duration of security A into weight of security A plus duration of security B into weight of security B plus duration of security C into weight of security C. Okay, so you know that every weight equals to 1. Okay, weight 0. Everything comes under 1 only. Okay, weight is equal to 1. Now there are some notes given. Okay, we won't read it now. After doing questions we'll read it, or maybe let it be. I'll just read it and try to make you understand now. If you don't understand, you'll anyways understand in the question. Okay, in the future duration of bond if in future duration of bond changes, then we have to calculate revised weights for each bond accordingly. So what it is saying, that let's suppose the 4 years bond. Okay, its duration is changing due to your required return. Okay, so we will have to calculate revised weight accordingly. Okay, I repeat again. Okay, let's suppose uh, your YTM, you always check out YTM, right? YTM is your required rate of return. Your required rate of return is changed um, in the mid years. Okay, so what happened now, due to change in YTM, your duration of the bond will also change. How is duration derived? It's your PVF into your discounted cash flows, right? Your cash flows into discounting factor, okay, into your PV. With PV you do you assign weights and you get your duration, right? So with the change of YTM, your duration of bond will also change, right? Amount to be invested initially in each bond on the basis of weight calculated above. Okay. Amount to be invested initially in each bond of the basis of weight calculated above. PV of liability to be settled using bonds YTM into paid of bonds as calculated above. Okay. So what you need to do when you get wait a second, I'll just interpret it. We'll look at it about afterwards. Okay, while doing question, if this note comes into action, if this note comes into use, I'll explain it to you. Right now I'm not understanding this. Okay, so we'll take out questions. So what is a question? Questions are very easy. Okay, I have marked also here very easy. So what it is, we'll see. Mr. A will need 1 lakh after 2 years. Okay, he'll need 1 lakh after 2 years. So this is terminal value. Okay, it is not PV date. Okay, after 2 years it is its maturity period, for which he wants to make one time necessary investment now. Okay, now means your present period. Okay, now they have given two details below of two bonds, bond X and bond Y. Face value, coupon, years to maturity, current price, current yield, all this information is given. Your current price is your market price. Okay, so everything is given here, and your current yield. Okay, what is yield? Yield is your rate of return. Okay, your YTM. That your required rate, your discounting factor. Advise Mr. A whether he should invest all his money in one type of bond or should he buy both the bonds, and if so, in which quantity. Okay, assume that there will not be any call risk or default risk. Okay, what is call risk or default risk? Let's see if it is useful in the question, or else we'll skip it. So what we need to do here now is we'll prepare PV of both. Okay, we need to take out weight of both. Okay, so how we'll do for bond X, we'll take face value is 1000, its coupon rate is 7%, that is 70 rupees. Okay, and its years to maturity is 1. Okay, so in just 1 year it will mature, and current yield is 9.7, and its current price is this much. Okay, and we are getting 10% as the yield. Okay, this is my discounting factor. Now this will be my this thing, what this should be my PV. Okay, so how am I going to do this? Normally years cash flow. Okay, first year he will get interest, and then in the first year only he'll get redemption amount also, because this is years to maturity is just 1 year. Okay, and we'll do PV 0.909, we'll take 10%. Okay, and proportion it is 1 year only. Okay, so weight is also 1. Now in bond Y, what we do in bond Y, we do the same thing. Okay, the first we take here cash flow. Cash flow, how much is it? 1000 into 8% is 80, and 4 years is getting interest. Okay, and in the fourth year only he is getting his principal amount also. Okay, so we need to do PV with 10%. Okay, PVF we have here, it is given. Okay, and a proportion of the bond value, that is a weight we have to assign it, and then we'll get our duration. Okay, so this is basic, we already learned this in duration part also. Okay, now what we need to do, we need to now is the main part of this chapter. Okay, so how will we do it? So question number 48. So the main part is here. Okay, we got both the duration, right? Duration of portfolio is equal to duration of liability, right? What is my duration of portfolio? It is duration of A into weight of A plus duration of B into weight of B, right? And here the duration of liability, it is 2 years, right? Now what? Sorry. We'll take X and Y. Okay, for easier understanding we take X and Y, because our bond are X and Y only. Okay, duration of X and duration of, what is duration of X? Duration of X is 1. Okay, 1 into, what is weight of X? Weight of X is 3.563 plus duration of Y. Duration of Y is duration of Y, X is 1. Okay, and its weight is not known. Okay, duration of Y is 3.563 into its weight, we don't know, is equal to 2, right? Now weight of X plus 3.563 into, now weight of X plus weight of Y is equal to 1, right? So weight of X is equal to 1 minus weight of Y, right? So we will use this. Okay, 1 minus weight of X, sorry, weight of Y is equal to 1 minus weight of X, right? So we are using it here. Okay, is equal to 2. So now we'll solve this. Weight of X plus 3.563 minus 3.563 weight of X is equal to 2. Now we'll solve this equation. Okay, this is 2.563x, 2.563x minus is equal to 1.563 minus. Okay, X is equal to how much? Is equal to 0.6098. Take it up to 4 decimals. Okay, X is equal to 0.698. Y will be 1 minus 6018 minus 1, 0.3902. Okay, so this is my weights. Okay, this is my weights being assigned. Okay, now how much should I invest in it? Okay, how much money do I need after 1 year? It is 1 lakh. Okay, is futures 1 lakh equal to present 1 lakh? No, right? So we'll PV it. Okay, so how much do we need for 2 years. What is my rate? 1.10. Okay, so 1.1 divided by 1 2. Okay, this is my discounting factor. 0.826 is equal to into 82645. This is my amount. Okay, this amount I need after today. I need to invest this amount so that I can get 1 lakh in 2 years. Okay, in what ratio we'll put? In this ratio. So into ratio 0.6098 and 0.3902. If we put it 82,645 into, it is 50,397, and here it is 32,248. Okay, we need to invest this amount in X and this amount in Y. Okay, is my answer matching? Yes. 50398. Here it is 386. Minor difference, it's okay. 32,214. Here 32,248. Okay. Now how many bonds do I need to purchase? We need to divide it with your market price. Okay, market price. What is my market price? The market price here is 972. Okay, and here it is 936. If I divide it, I'll get 52 bonds, and here I'll get 34 bonds. Okay, very simple. We'll move on to the next question. This one is a full-fledged sum. Okay, we'll see how it is. The following data are available for 3 bonds. Okay, 3 bonds ABC. The bonds are used by a portfolio manager to fund an outflow scheduled in 6 years. So 6 years is my liability period. Okay, current yield is 9%. This is my discounting rate. All the bonds have face value of rupees 100 each and will be redeemed at par. Interest is paid annually. Okay, face value is 100 and it is redeemed at par, and interest is paid annually. So no semi-annually concept. We have been given here that bond A maturity, bond A, B and C, its details are given. Okay, so bond A's maturity is 10 years and its coupon rate is 10. Okay, so how much will it be? It will be 10 rupees only. And here it will be 11 rupees, and here it will be 9 rupees, and maturity years are given. Okay, now we need to calculate duration of bond. How we'll do PV table. Okay, we'll have to draw up the PV table. Bond A, year cash flow. Okay, at the end of the year we'll get our redemption value back. We'll do PV with 9%. Okay, our discounting rate I already told you. Okay, we'll do it, and we'll assign weights to it. Okay, and we'll multiply this with the year. Okay, so we'll get an amount which is a period of bond A, which is the duration of bond A. Okay, next for bond B, the same process will continue, and bond C, the same process will continue. We'll get duration of each bond. Now comes our main part, that is our calculation of weights. Okay, question number 49, calculation of weights, second one. What they have asked, the bond portfolio manager has asked. Okay, before that, let me tell you how many bonds do we have? A, B and C. Okay, so this is 6. Okay, weight of A, B and C we need. So this is equal to 1. I am just talking about your weights. Okay, this is equal to 1. Now in math, how will you do it? If you have one missing value, you can find it, but if there are 2 missing value, you cannot find it, right? So it is a dilemma here that we need at least one value to be filled up, okay, so that we can find one missing value. So here they have given us that the bond portfolio manager has been asked to keep 45% of the portfolio money in bond A. Calculate the percentage amount to be invested in bond B and bond C that need to be purchased to immunize the portfolio. Okay, so what they have told is in bond A already 45% has to be kept. Okay, so remaining amount we need to keep in the remaining bonds. Okay, so what is my formula? It is duration of A into weight of A plus duration of B into weight of B plus duration of C into weight of C is equal to how much? 6, my liability. Okay, what is my duration of A? My duration of A was 6.86 into what is my weight of A? It is 0.45, right? They asked me to keep 45%. Okay, plus duration of B is 5.84 years. 5.84 into weight of B is unknown plus duration of C is 4.24 and weight of C is unknown, okay, is equal to 6. Now what happens here? We have to do multiply. 6.86 into 0.45, 3.087. Okay, 3.087, we'll take it to that side. 5.84 into weight of B plus 4.24 into weight of C is equal to 6 minus 3.087. Okay, minus 6, we get 2913. Okay, we get 2.193. Okay, now tell me, already 45% is being assigned to, there are 3 portfolios A, B, C, okay, is equal to 1. Okay, now A is how much? A is 45%. So how much will this be? 100 minus 45% is equal to 55%, right? B and C will have 55% weight. Okay, so both these will have 55% weight only. Now we can do it. How? Weight of C is equal to 1 minus weight of B, right? So we'll do, sorry, here 1 will come out, here it will come 0.55. This is wrong. 0.55 minus weight of B, because already 0.45 is given to weight of A. Okay, 5.84 into weight of B plus 4.24 into 0.55 into weight of B minus weight of B. Okay, so if we solve it, we'll get 5.84 weight of B plus 4.24 into 0.55, it is 2.332 minus 4.24 weight of B is equal to 2.913, right? Now if we solve this equation, minus 2.913 1.6 weight of B is equal to 0.51, weight of B is equal to 0.3631. Okay, we take it in 4 decimals. Okay, now I got weight of B. My weight of C is equal to minus 0.55. It is 0.18 0.69, right? Now we just need to assign it to the respective okay, I'll just solve it. Okay, how much do we need? They have not given the outflow. Okay, they have not given the outflow, so we need not find it. Okay, they have not given the outflow, they have just given 6 years time. Okay, now what they are saying, that after the portfolio has been formulated, the third part, an interest rate change occurs, increasing the yield to 11%. So as I told you in notes also, that if your yield increases, okay, if your yield changes, your discounting factor changes, and your PV changes, and your duration also changes. So here duration has been changed. The new duration of the bond are given here. Thank God they didn't give. Thank God they gave the duration. If they wouldn't have given the duration, we have to have solved it again. We have to find out the duration again. So they have given here. So we'll take it into use. So how much they are given? Bond 7.15 and bond B 6.03 and bond C 4.07. So what they are asking is this portfolio still immunized? Okay, is the portfolio still immunized? We see, okay, A is equal to 7.15 into 0.45, okay, B is equal to 6.03 into 0.3631, okay, C is equal to how much? 4.27 into 0.1869. So how much we are getting? 0.45 into 7.15, it is 3.2175. 6.03 into 0.36, it is 2.1895. 4.27 into 0.1869, it is 0.7981. If we total it, how much is it coming? Plus 2.1895 plus 3.2175. It is coming 6.21. Okay, it is what? It is exceeding. It is exceeding my liability period, right? What was my liability? It was 6. So how much extra am I getting? Minus 6.21. So extra 0.21 minus it is coming, right? So extra 0.21 period is coming. So this is not immunized. Okay, the bond is not immunized. So what they have asked is, determine the new percentage of B and C bonds that are needed to immunize the portfolio. Bond A remaining 45% of the portfolio. So now what they have asked, that to calculate new weight. Okay, so how we'll calculate new weight? By using the same formula like here. Okay, duration of bond is equal to duration of portfolio. If we do it, we'll get it. So already solved here. Okay, see, now the weight of A was 0.45. I deducted it with the duration of portfolio 6. So this was my remaining thing. Okay, so now I substitute the value of B. Okay, and if I solve the equation, I get weight of B as 0.2466 and weight of C as 0.3034. Okay, weight of A is already 0.45. It is given in the question. So we'll check the answer. See, on solving this equation, we get value of B comes to 0.2466, 0.3034, and accordingly the percentage of investment will be 25. Okay, so as we solved, it is the same. Okay, it was easier. Okay, the bond immunization topic is very easy, so just practice it once and you'll get the hang of it. Okay, tata, bye bye.